Mutual funds, they sound complicated, right? You might be thinking, how do they work? Or are they really for me? But trust me, they're not as scary as you think. In fact, they can be a very user-friendly way to start investing. In simplest terms, a mutual fund is like a big basket of stocks or bonds. Imagine you want to invest in the stock market but don't know which stocks to pick. Instead of buying one stock, you buy into a fund that owns many. This means your money is spread out over a variety of investments. This gives you instant diversification. Diversification is a key strategy in investing because it helps manage risk. Think of it like a buffet. At a buffet, you get to try a little bit of everything. You get a taste of everything instead of just one dish. Similarly, with a mutual fund, you get a piece of many different investments. That's what a mutual fund does for your investments. It allows you to own a small part of many different companies and industries. It spreads your money across different companies and industries. This way, if one company or sector doesn't perform well, others might do better, balancing out your overall returns. This helps reduce risk and potentially increase your returns. By not putting all your money in one place, you lower the chance of losing it all. So, if you're looking for a way to invest in the stock market without putting all your eggs in one basket, mutual funds are a great option. They offer a way to invest in a variety of assets without needing to pick each one yourself. They offer a simple and affordable way to build a diversified portfolio and grow your wealth over time. Whether you're a beginner or an experienced investor, mutual funds can be a valuable part of your investment strategy. Before we continue, if you like this video, please remember to share it with your friends, hit the like button, subscribe to the channel, and then watch some more of our videos. Mutual funds work on a simple yet powerful principle: pooling. This concept is the backbone of how mutual funds operate and why they are so effective for individual investors. Imagine you and your friends all want to buy a big, expensive pizza. Alone, it's too pricey. You might not even be able to afford a single slice. But together, you can share the cost and enjoy the feast. By pooling your money, you can afford a much larger and more delicious pizza than you could on your own. That's what happens with a mutual fund. It's a collective investment scheme where many investors come together to pool their money. Many investors pool their money together. This combined capital is then managed by professional fund managers. This large pool of money allows the fund to buy a wide variety of assets like stocks and bonds, which would be difficult to do individually. The fund managers use their expertise to select a mix of investments that align with the fund's objectives, which would be difficult to do individually. As an individual investor, you might not have the resources or knowledge to diversify your investments effectively. This pooling power gives you, the individual investor, access to a diversified portfolio. Diversification helps spread risk, so if one investment doesn't perform well, others might, that you might not be able to afford or manage on your own. It reduces the risk of losing all your money on a single investment. It's like having a team of expert pizza chefs working together to create the perfect pie for everyone to share. Each chef brings their unique skills to the table, ensuring that the final product is something truly special and enjoyable for all. In the same way, mutual funds bring together the expertise of professional managers and the collective power of many investors to create a financial product that benefits everyone involved. Let's talk about diversification. Remember that buffet we mentioned earlier? That's diversification in action. Instead of loading up on just one thing, you sample a variety of dishes. Diversification in investing works the same way. A diversified mutual fund holds investments in many different companies, industries, and even countries. This approach spreads your risk. Think about it. If one company in your fund isn't doing well, others might be thriving. This helps protect your investment from major losses. It's like having a safety net for your money. Why is diversification so important? Let's say you put all your money into one company, and that company goes bankrupt. Ouch, you just lost everything. But if you had diversified your investments, the impact would be much less severe. Even if one investment goes south, the others can cushion the blow. Diversification is key to mitigating risk and building a more resilient portfolio. It's like having a backup plan for your backup plan. Section 5. The expert in the room: professional fund management. Another great thing about mutual funds is that they're managed by professionals. These are the financial experts, the market gurus, the people who live and breathe investments. Fund managers use their expertise to research companies, analyze market trends, and make informed investment decisions on your behalf. They're like the captains steering the ship, navigating the market waters to try and reach your financial goals. Of course, there's no guarantee of success in the market, but having a seasoned professional at the helm can give you an extra edge and peace of mind. Section 6. Picking the right basket. Different types of mutual funds. Just like there are countless pizza toppings, mutual funds come in all shapes and sizes. Some funds focus on specific sectors like technology or healthcare. Others invest in bonds or real estate. There are even funds designed for specific goals like retirement or your child's education. With so many options available, it's important to choose funds that align with your investment objectives and risk tolerance. Don't be afraid to do your research, talk to a financial advisor, and find the funds that are the right fit for you. Section 7. Fees and expenses. Understanding the costs. Like any service, mutual funds come with costs. These are known as expense ratios, and they cover the fund's operating expenses, including management fees. Expense ratios are expressed as a percentage of your investment. A lower expense ratio means more of your money is working for you. Always compare expense ratios before investing in a fund. Remember, every penny counts. Section 8. Mutual funds versus stocks. Which one is right for you? So, you're convinced about the power of investing. You've seen the potential for growth and the benefits of putting your money to work. But now comes the big question. Should you choose individual stocks or mutual funds? This decision can shape your financial future. Well, it depends on your investment style, risk appetite, and how much time you want to dedicate to managing your money. Are you someone who enjoys diving deep into financial reports and market trends? Mutual funds offer instant diversification and professional management, which means your money is spread across various assets, reducing risk. This makes them a great option for beginner investors or those who prefer a hands-off approach. You can rely on the expertise of fund managers to make investment decisions for you. Stocks, on the other hand, require more research and carry higher risks. You need to stay updated with market news and be ready to make quick decisions, but they also offer the potential for higher returns. If you pick the right stocks, your investment can grow significantly. Ultimately, the best choice for you depends on your individual circumstances and financial goals. Consider your time, knowledge, and risk tolerance before making a decision. Both options have their merits, so choose wisely to align with your financial aspirations. Section 9. Conclusion. Mutual funds, a smart investment choice. Mutual funds, they're like the all-in-one package of the investment world. They offer diversification, professional management, and a user-friendly way to participate in the stock market. While there are risks involved, as with any investment, mutual funds can be a powerful tool for building wealth over the long term. So do your research, choose wisely, and watch your money grow. Remember, investing is a marathon, not a sprint. Start early, stay invested, and let the power of compounding work its magic. If you liked this video, please share it with your friends, hit the like button, subscribe to the channel, and watch more of our great videos. Thanks for watching.